One of the things I want to do each week in order to help people retire strong is to really point out to them something that they may not be looking at or something that they don't have their attention on. There is an investment this week that is about to break out to lifetime highs. And in many ways, it already has broken out in lifetime highs. I'll talk about what I mean by that, but it is breaking out. And this matters if you want to retire strong and grow your portfolio going into and staying into retirement. Stick around. I'm going to talk about what that one investment is and why it matters so much. Okay, speak to you then. Hey everybody, RC Peck here with Fearless Wealth, and what we do each week is point out the one thing that can really help people retire strong. Now here's the thing, you don't want to be changing and adjusting every week. It is fun, but you don't want to have to be looking at the market. You want to do it if you want to. Most people think they have to be looking at the market, probably because they fired their big box advisor and they realized they were smarter than them and they weren't really helping them. So I don't want you to think each one of these weekly things is oh my God, now I got to do that, now I got to do this. The point is, in order to retire strong, you have to do two things. One, avoid 50% falls. That sounds kind of obvious, but most big box advisors don't do that. And two, when the market is in those stable uptrends, 88% of the time, you got to be fully in the market. Now, let's talk about what I want to talk about and show you this week. So what it is gold. Now, this is a price chart that is about 20 years in range. And that red line is the 2011 high in gold. Call it $1,900. Okay, that was a long time ago. 12 years ago. It might feel like yesterday to some people. But here's what I want to point out to you. You can see how gold was trying to get above that $1,900 an ounce when priced in dollars. And the sellers kept coming in and said, take my ounces of gold, take my ounces of gold every time gold got above that $1,900. But notice how the temps now are getting more and more, and now gold is again above the $1,900 mark. Now, this is close of market, so it's actually at $1,973 as I record this today, close of market. But again, the point is to just show you how now we're above that $1,900 mark, and that's important because the more times a price resistance, that's what that is challenged, the more likely it is to break. So I think this is a when, not if it breaks it. And that could be the break right there. But as you can see, these things take time. So this is, I think, a pretty big thing because now the price is getting to stay above the $1,900 mark more and more. And look, if you price this in yen or euro or British pounds, you would see the price of gold at lifetime highs. So this is what's capturing my attention this week. Now this is a zoomed in picture. So the first price chart I showed you was a 20-year price chart. This is 3.5 years. Now I have 3 red lines there. It's red when the price is below, it's green when the price is above. So I have 3 lines there because gold closed at $1,900 back in September of 2011, but intraday high was about 1,920. So that range right there is just literally showing you intraday high to closing of the day high. And you can see that gold is above it. It tried to and stay above that 1,900 mark back in January, but it got sold off. People literally supplied the market with their ounces of gold. And now here we are above. And you can see if you're watching this, not just listening, the price is coiling above its high in January. So it's coiling above, and that's a sign of stability, sign of strength. So we have gold coiling in the high 1900s. So here's what matters most. If this breaks loose this time, maybe this week, maybe next week, maybe in a month, but when it does, the next major move is about what this whole bottoming pattern was. So if you look at that bottoming pattern, the move from the bottom to the red line there is about an 80% move, right? So if you have $2,000 gold, you're basically looking at the next major upside target to be about $3,600. And in the world of instability and craziness and inflation and bank runs, I was almost going to say not, but that is what is happening. There are bank runs. People are taking their deposits out of banks. Here we have gold going, oh, okay, something's going on. Because think about this. This is March 9th right here. Let me get March. That's kind of March 9th before the price moved higher. And since that was March 9th, everybody thought the world was fine and okay. And you see gold moving up. Now, the other thing I want to point out actually two more things. This is gold priced in S&P 500 units, literally SPY. So I'm taking GLD, pricing it in SPY. And what I want to point out to you on here is gold relative to the S&P 500 with dividends reinvested bottomed back in 2022, literally the end of 2021 and the beginning of 2022. And it's literally battling in a similar way how gold itself is battling that breakout. That gold here is battling another breakout relative to the S&P. And if you've been in my world for any amount of time, you know that the S&P is a really hard investment to beat. And here it is, it's been outperforming the S&P since really the end of 2021. And as this price chart kind of moves through that overhead supply, it's gaining more and more strength. The last price chart I want to show you is pricing gold in US bonds, specifically TLT, long-term US bonds, 20-year plus bonds. And as your brain can see in here, it's been in an uptrend for this entire 3.5 years. So what that's telling us is people are preferring gold over bonds. Gold is starting to outperform the S&P 500, and gold itself is up near those lifetime highs, literally attempting to break out to a new lifetime high, which back in 2022 was about $2,040. And back in 2020, it was just a little bit higher at $2,073. So we're about $100 away from new lifetime highs in US dollars. Now let's talk about why this matters and why it matters to retiring strong. So most people believe you should always have a hedge and have money in gold. I disagree with that because most of the time gold is, not doing anything. So you don't want to own something that's not doing anything. You actually only want to own gold when it's beating basically, quote unquote, everything. So it's outperforming US bonds, outperforming international bonds. It's at a minimum going head to head with the S&P 500, which is really hard to beat, but really looking like it's going to break out soon. And what we do know about gold is once it breaks out, it really gets moving to the upside. Now, when gold moves like that, right? When gold moves from 2,000 to 3,000 to 3,600, it captures a lot of people's attention and it can move very quickly. It's also a sign of people questioning where to put their money. Or maybe they're not questioning, but they're questioning, I don't know if I want it in the stock market. I don't know if I want it in the bond market. I don't know if I want it in the quote unquote cash market, US dollars. So they put it in this place called gold because they're worried about the future just a little bit more. And so that's what I see going on in the market right now. Yes, the backdrop is regional banks imploding. 2 have already gone bankrupt. Again, if you remember, Bear Stearns imploded in March of 2008. Lehman Brothers was at the end, or it was actually mid-September, call it 6 months later. And then the market bottomed 6 months after that. So we are nowhere near in the clear with this banking crisis. We have a huge amount of commercial real estate to get repriced this year. And the biggest holders of commercial real estate are regional banks and small banks. And all of that real estate is going to be getting repriced lower with interest rates higher. So we do have more pain coming. Thanks, guys, for being in my world. I appreciate it. Let me know where you think I got it right, where you think I got it wrong. Like, subscribe, leave a comment. All of those things help the algorithm to get this video out to more people. And if you're curious or you're questioning your advisor and his approach or her approach while you're in 50 symbols and you're in kind of the 60-40 or the 80-20 or the 70-30, then go ahead and look into the description and we will do an x-ray of your portfolio and tell you exactly where you're losing on average about $35,000 per million per year. So let me just say that again because that's actually the average we find. For every $1 million invested in the market, we find typically a missing $35,000 per year per million. That means not changing risk profile, risk tolerance, volatility. It literally means plugging the leaks and getting that over diversification, which a lot of people are, eliminating that problem. Thanks, everybody. I appreciate you being in the world, and I will speak to you next week. Okay, bye.